International Corporate Tax, Module 3, Worldwide Taxation and Profits. General introduction. When discussing taxing profits worldwide, it is important to take into account several issues that occur at the same time, and although sometimes they go in the same direction, they do some in opposite directions sometimes. In other cases, corporate tax is the tax that must be paid for various types of business, clubs, cooperatives, and joint ventures on the profits of their activities. The regulations are established by national authorities and may be different for each country. As already seen in corporate tax in Spain, the taxation of profit is one of the ways that the state has to finance itself and pay its official schools, universities, hospitals, etc., etc. The government of a state and its policies will largely determine the tax measures that will be taken towards citizens and companies operating in that country. For example, in a country with a social democratic government, taxation is probably higher, while a country with a liberal government will tend to reduce taxes since it will consider that the market can self-regulate. However, this is not only an issue that must be considered. If a government wants to control companies that operate in its territory, it cannot ignore that the world is more and more globalized and therefore can no longer act unilaterally for this reason. Paying attention to the realities of the world economy will modify its tax policies. Taxes of a state can adapt to this reality, and there are many cases to show this. Although some regions want to harmonize taxation, as will be seen later, there are countries in the European Union whose taxation varies considerably. The trend has generally been to reduce taxes. The average in the EU is 21.29%. However, there are countries that maintain this level at 25%. As seen, Spain is actually one of them. In other countries, like Germany, 30%, and some countries even 33%. France. On the opposite side, there are countries that have chosen to reduce the tax rate. 21 for Portugal, 12.5 for Ireland, and even 10 for Bulgaria. Among the latter, Malta draws special attention. Although its tax rate is officially 35%, one of the highest, it can actually be reduced to 5%. According to what is called tax engineering, which is legal mechanisms allowed by the law that companies can take advantage of. These mechanisms may seem unethical and in some cases have caused controversies in the rest of the EU partners because they allow large companies to settle there to pay low taxes and operate in the rest of the member states without having to pay taxes for all their activities. Now, looking at this, it can be seen that states must find a compromise between taxing the companies that make up its economic fabric and making investments in the country attractive. The nature of business is economic, therefore a country with lower taxes will be much more attractive than a country with higher taxes. Part of this determines the competitiveness of the country, so it's one key issue, but it is not the only one. Indeed, it can be seen that countries with lower taxation rates have attracted large multinationals such as Microsoft, Facebook, Google, and Amazon. On the other hand, letting low taxation take all credit for large companies placing their headquarters in these countries means not considering all the existing reasons. There are organizations which require their headquarters to be located in a country with a good relationship with other markets, or to be physically well connected with their suppliers and customers. In Spain, the taxation rate has dropped by 5%, and it has not been such a big change. In the US, the tax rate was higher before 2018 and continued to be attractive to other companies. In this context, the economy of the country and its relationships with the global economy has a determining influence. If our company pays low taxes but does not have customers who can acquire our products or services, profits can not be obtained. This graph includes a list of corporate profits. If we compare the profits with the corporate tax of each country, it can be seen that the highest profits are not always obtained in the countries with the lowest taxes. Therefore, states have to find a balance between their public expenditures and their tax policies in order to collect what they need to pay for public services and taxes for companies so that they are attractive enough for higher investment. This is the reason why global profit taxation cannot be discussed, but each country or even region or bilateral or multilateral agreements between countries should be addressed to see what kind of taxes every country has. So let's have a little quick look here. Now let's see, we've got quite a few. Not making much sense of this chart at the moment, but okay, let's see what we can make of it, and then we'll go back. Oh, I see. So if it's red, it means that the profits in that country has kind of gone down. Russia's gone down a bit. I don't make much of that, actually. As previously mentioned, some regions have started to regulate basis on taxes. As usual, it is a costly process since each country wants to retain its sovereignty, especially economically, and certain tax policy also involve responding to a demand that does not always come from the same sector. In some cases, this demand comes from citizens, or in other cases, from the business fabric. Each of these sectors want favorable conditions, and it can also happen that they have the same demand. That said, it cannot be ignored that except some countries with dictatorial governments, or countries with interim technocratic governments, those that have political power are parties with a specific ideology, or they will generally prefer to meet the demands of one or two sectors, even though a compromise solution can also be obtained. Now, given these considerations, when wanting to start a business activity in a country, in addition to conducting a relevant market study, it is advisable to research on its political structure, its stability, and its tax tradition over the years to be able to understand where the tax policy is being directed and decide if it is convenient. The United States illustrates this case, since it is a country with a liberal tradition, and yet its taxation has been, until 2018, one of the highest. Now, there has been a general tendency to lower taxes on companies in recent years. Although there are differences between the taxes paid by companies between countries, the tendency is to reduce the tax burden on business activity to increase indirect taxes. Now, excluding Malta, as commented on, its percentage can be reduced. European countries have been reducing taxes on corporate profits for 20 years to a greater or lesser degree. Again, it is about making the country competitive and making companies want to invest. Corporate taxation in the European case exemplifies this trend, since it went from 35% to 21% on an average in recent years. This is not the only case. The world trend is the same. There are links in the annexes that show a comparison between taxes by region and periods. As mentioned before, the economy has become global. In this content, the market economy is based on multinational companies moving capital. From this moment forward, the economy stopped being local or regional, since ramifications can be spread throughout the planet. As an example of this is the European Union and its free movement of persons, goods, and capital, even though there are other regions that also want to have a common framework for business, such as Mercosur, the North American Free Trade Area, also known as NAFTA, or the ASEAN, the Association of Southeastern Nations. Mercosur, yeah. I'm going to look that one up if you don't mind. Okay, Mercosur is South America. And you have your North America, South America, Asia, European. I see where this is all going. Okay. Given that the economy goes from a specific region of the world, it is logical that tax trends has been downward. In this situation, states want organizations to invest in them. However, as previously mentioned, there is still a need to finance social services. So the solution to maintain the inflow of money into coffers of states involves increasing indirect taxes. In some areas, there are more differences, but generally corporate taxes have been decreased and indirect taxes have been increased. This trend, however, should not take our eyes off the impact of a country's taxation has on the economy of our organization. If we manage to optimize the planning of our finances properly, we will be able to save important amounts of money via taxes. We must also know the agreements between countries in order to avoid double taxation. Agreements to avoid double taxation. We've mentioned this before. Part of the agreements to avoid double taxation were seen in the section on corporate tax in Spain. This section introduces a more international view of them and shows some examples of agreements. Double taxation agreements are agreements between countries that avoid being taxed twice for the same product, so that if one of our offices is in one country and the head office is in another, we do not pay the same tax on both countries. These agreements exist due to the fact that each country has a sovereign right to define its own taxation legislation. However, in the current global economy, this means that the taxation between countries overlaps, so that a natural or legal person can be taxed in two countries, but the same income or good can be taxed in two different countries. The general rule on which to establish these agreements are given by the OECD models already seen, and these agreements have a principle of non-discrimination, so that the signatory countries must use similar tax regulations for the residents regardless of the nationality, and to the companies that carry out their activities in the state regardless of who their shareholders are or where they come from. Hence this little problem we're having with the Chinese on the west coast of Canada. In addition, there is also a mutual agreement procedure principle by which any tax resident of a signatory state can urge an amicable interstate agreement between that state and their own, and if they consider that the agreement has not been correctly applied to them. Finally, there is a principle of mutual assistance that, in addition to avoiding double taxation, aims to exchange information and cooperation to prevent fraud and tax evasion. These agreements prevail over the domestic laws of each of the signatory countries. Here we have an example, a common consolidated corporate tax base. It has been already mentioned that there are significant differences between the tax policies of each member state within the European Union. However, recently there is a call for harmonization of the tax base, or CCTB, has begun work on this harmonization. Just a moment, please. Yeah, we don't need to show that. Yeah, okay. Right. Back to our story. Yeah, and it is a set of standards that EU member states can apply in their respective corporate tax laws without any membership losing its national sovereignty. The CCC, the CCCTB, began in 2011, although it was stagnated for several years, mainly due to the complaints from countries whose economic interests are against these proposals. Ireland, for example, it was relaunched in 2016 with a couple of key changes. First, it would be mandatory for large organizations so that all companies with high turnover and profits would be included. And secondly, it would provide great incentives to companies that invest in R&D. And although there was progress, the CCCTB has not yet been implemented. Now we come to OECD and BEPS. As seen before, it is an international body that makes a number of recommendations that are basis for establishing agreements to avoid double taxation. One of the most noticeable elements is the Multilateral Convention to implement tax treaty related measures to prevent base erosion and profit shifting, which identifies and keeps track of the tax practices of some organizations. Using different loopholes, the company can pay absolutely nothing in any of the countries in which it operates. The BEPS also points out that due to the legal loopholes, companies can even hide or make the real profits disappear to avoid taxation. This is not really illegal, but it is a serious problem since it causes inequalities between states and between companies. States lose money, and in the current context after an economic crisis with countries that have not yet overcome it, it is difficult to develop growth policies without increasing taxes to citizens or ignoring their needs. Regarding companies, there is an inequality between those that can operate on a large scale and the smallest ones, which are not able to move their capital or profits as large corporations do. The collection in the form of taxes to companies is a large income for the state. The existence of BEPS involves the loss of these countries and for their development, regardless of how development of the country is. Actually, BEPS is in every country in the world because many tax regulations are obsolete and do not adapt to the realities of the 21st century. We are facing a serious problem due to the globalization of the economy. The BEPS project was implemented in 2013 to fight against these practices, and it can be summarized into 15 actions. Trying to manage the fiscal challenges of digital economy, neutralizing the effect of hybrid devices, strengthening the rules of international fiscal transparency, actions limiting the base erosion through deductibility of interest and other financial payments, increasing the efficiency of measures to counteract harmful tax practices, taking into account transparency and substantivity. Action 6, preventing the abuse of conventions to avoid double taxation, preventing deliberate avoidance of permanent established statuses. 8, 9, and 10 are ensuring the results of transfer pricing correspond to the creation of value. 11 is establishing methods to collect and analyze data on base erosion, profit sharing, and measures to address this issue. 12 is asking taxpayers to report their aggressive tax planning mechanisms. 13, new analysis of the transfer pricing documentation. 14, making dispute resolution mechanisms more effective. And 15, developing a multilateral instrument for the application of development measures. Now we have some other agreements. There are other agreements between regions, mainly between the EU or the United States and the rest of the countries. Some are already being implemented, such as NAFTA, the economic area, or the Asia-Pacific one, and the one of West African states, and others, such as TTIP, and they're still being negotiated. These agreements aim to establish a dynamic bilateral or multilateral common trade area among the number of countries or regions to improve trade and exchange among its signatories, to provide conditions for fair competition, to make investments attractive, or to offer solutions to litigation, among other objectives. Digital taxes. One of the most controversial areas regarding taxing profits is the digital tax, mainly because the companies in this field have a new structure and their product or service is intangible. Social media, electronic sales services, transport platforms, and search portals. So far, technological companies have completely changed the way of approaching business and have directed it to offer services to as many people as possible. And among these companies, we can find the so-called GAFA, Google, Apple, Facebook, and Amazon, and some of the companies such as Uber, Spotify, or Airbnb. Their pervasive role has modified many habits among the consumers and in many companies. As double taxation and BEPS were produced by a gap between laws and economic evolution, a similar situation can be found in technological companies. Technological companies say that the income obtained in the countries where they work only cover the cost of intellectual property and intangible assets that are usually located in tax havens. This argument is key to reducing their tax burden, since profit tax is where they generate value and are not where the income is collected. For example, an essential issue is where the use of the digital services generates value. Some experts say that they do, since users of the digital services generate value for digital companies, though through network effects. The existence of a new user increases the usefulness of the other digital participants. Under this approach, companies generate value in the jurisdictions in which their users are located. Therefore, it is legitimate for the governments to tax associated profits. And of course, the problem comes with their quantification. Large technology companies have taken advantage of the fact that their fast growth has not had a direct correspondence with the development of the laws that are adapted to the digital reality. When the taxation of GAFA regarding their benefits is observed, this gap is reflected. However, Sometimes a tax gap has another origin that was already mentioned. A laxer tax system allows a country to attract many technology companies, which are usually very well valued for the added value they bring to the country's economy and the talent they attract. This is the reason why there are many countries opposed to legislated taxes on technology companies globally. Some countries have begun to legislate on taxation on technology companies in an attempt to bring the tax burden into line with traditional companies and to increase their state revenues. In Europe, technology companies pay 9.5% on average compared to 23.2% on traditional companies. This difference creates an inequality of opportunity since technology companies can operate globally much more easily than traditional companies, apart from the fact that their profits are usually higher. This is why tax harmonization is sought, especially when the tax difference is in a common area. For some years now, as with corporate tax, the way to legislate the tax on technology companies is being studied. Some EU member states have led a campaign to increase taxation on GAFA, and these countries such as France, Italy, Spain, Portugal, Slovakia. On the other hand, some other member states do not want such tough legislation, such as Ireland, Luxembourg, Malta, Sweden, etc. These countries have a lower tax rate and have attracted companies in that sector. For this reason, even if there are attempts to regulate it, it will be very difficult because many interests are intertwined. According to the community regulations, all countries must approve of the measures unanimously. The OECD has worked hard in regulating the situation. Its proposal is to tax. Let's make sure that we're going here, bud. Yeah. Proposals to tax on the revenue in each country in which it operates instead of taxing on its benefits, as it will be what is being done, as it will be seen what is being done so far, taking advantage of lower taxation of some countries and agreements against double taxation. And in this way, double taxation, tax engineering are avoided. However, the main problem is that the available data on these companies is not readily available. EU has proposed a 3% on certain digital services offered by these companies, provided that they invoice more than 750 million euros annually worldwide and 50 million euros annually within the community area. However, they're still far from being approved, not only because of the conflicting interests previously mentioned, but also because the proposal was presented as a temporary solution until a harmonized corporate sales tax could be approved. At the global level, the OECD fears for fragmentation regarding the digital challenge, not only between countries, but between regions. Some criticisms just a moment, we'll check again. Yeah, some criticisms have been made refer to a European attempt to stop the economy of the United States, since most technology countries are in that country. The harmonization of the digital tax is not only the responsibility of the EU, but it is a concern of all the OECD and G20 countries. Even with the efforts of a large part of the international community, digital rates still have a long way to go. Canada proposed a direct tax on Netflix. Finally, it ended up becoming an agreement with a company to which it was committed to invest $500 million for 5 years for the creation of content, including 25% for the French language production. The USA knows that the non-existence of a digital tax means not collecting a large amount of money. That is why they are trying to reevaluate taxation and laws to adapt to the new times in which the technology economy has changed everything. There are some taxes on some technological services, such as the downloading of music and films, or using a platform such as Netflix or Spotify. Because of the USA states it can add taxes, the Streamlined Sales Tax Governing Board exists since the year 2000. It is a group that finds solutions to the complexities that the North American taxation system sometimes have. The result of these meetings is that the Streamlined Sales and Use Tax Agreement, which aims to simplify and modernize the tax rules so that they can be applied to any type of tax, including digital. These examples show how difficult legislating this type of society is. Conflicting interests, fast changes in the business model, and outdated laws, disagreement on what is considered a digital service. Corporate taxes in Portugal, here we go, is called the imposto. Okay, Functioning of this tax is stated in the, it is a state tax, even though Portugal's local administrations can vary it. I think I will stop here because my voice is shot. Corporate tax in Portugal, as you can see by the name, it's a state tax, even though Portugal's local administrations can vary it, as will be seen later. The fiscal year in Portugal corresponds to the calendar year. A different period can be suggested for Portuguese and foreign companies, which require a minimum of 5 years of follow-up. In their financial statements, companies must present a balance sheet, an income statement in the form of a table, and an annual report called DOG. For all companies, the IFRS are applied. SME are an exemption. They can choose between following the standards or the Portuguese standards. Subsidiaries of foreign companies that do not follow this must use the Portuguese regulation. And in general, the companies with headquarters or domiciles in Portuguese territory are considered residents of Portugal for tax purposes. They are subject to the Portuguese tax laws. Furthermore, since Portugal belongs to the EU, any person or entity of the Union can be established in this country will have the same treatment as if they were Portuguese. Foreign companies may be established as Portuguese companies or as subsidiaries of foreign companies without a very different tax regulation. In a company designated as a foreign capital company, more than 20% of the capital belongs to one or more, and more than one or more persons, natural or legal, non-resident, and in. On the other hand, Portugal has a Madeira free tax zone, also known as Madeira International Business Center, created in 1984 to promote and develop national and foreign investment. And it is interesting because it involves some benefits of companies that will be briefly discussed here. Resident companies are usually taxed on their worldwide profits. Non-resident companies with a permanent establishment in Portugal are subject to corporate tax on the profit attributable to the permanent establishment, and in this case, Portugal. Portuguese tax rate is 21%, to which, say, municipal surcharge is added up to 1.5%, depending on the municipality. And the national surcharge, and in this case, is 3% on the profit higher than 1.5 million euros, 5% on profits higher than 7.5 million euros, and 7% on profits higher than 35 million euros. The final rate, therefore, can reach up to 31.5%. These same rates apply to foreign companies, except for non-resident companies, which enjoy preferential tax regulations in their country of residence. And they're included in the Portugal's blacklist, whose taxation will be 35%. Interesting. There's a special reduced rate of 17% for SMEs. Companies with a registered office or activity headquarters in the autonomous community of the Azores benefit from a reduced tax corporate rate of 16.8. Companies within the MIBSC is to begin their installation by the end of 2020. At the latest, will have an even lower tax rate of 45% until 2027. And this rate can be applied to profits arising from transactions carried out with other non-resident companies or ones authorized. The table shows a summary of what is being discussed. 21% non-resident companies in the Azores, yes. Companies with an MICB. State surcharge could be 3, could be 5, could be 7. Municipal surcharge, 1.5. Exemptions. Corporate tax exemptions. Public authorities, immune to business goals, social security, storage, capitalization funds, among others. Corporate tax filing. Annual filings whose deadline May 31. The year following. Other presentations, acquisitions, without holdings, and benefits. Corporate tax in Brazil. Corporate tax in Brazil is called, as you see, it is important tax that companies have to pay, but it is not the only one. Brazil has a very complex tax system regulated by the constitution and by its tax codes. Administrations have the power to tax according to whether they are federal, municipal. So companies in Brazil will have to make sure they comply with their obligations at all these levels. The Federal Tax Administration has got this name. The federal year in Brazil is from January to December. Companies must submit at least a balance sheet, a statement of income, and note of tax returns. These documents will be required 60 days before the general meeting of shareholders. And in 2008 to 2010, Brazil adopted international accounting standards. However, Brazil has not yet a full partner, but one of those so-called key partners. Recently, progress has been made in adding country to the organization, and this is the reason why, in some cases, the tax rules established or local regulations are different from the model. And in any case, they are agreements to avoid double taxation, so any organization must check all these estimates. In Brazil, the condition that satisfies or distinguishes between a resident company and a non-resident vary. They consider a resident in Brazil if they're established under Brazilian law. We have seen that in other places, the residence is determined by the center of power. Companies whose residence is in Brazilian territory pay their taxes on their profits worldwide. Foreign companies are not subject to taxes except if some of their operations involve companies or agencies based in Brazil. And this is due to the fact that in the current regulations, the universal principle worldwide income prevails over the territorial principle local income. A company must bear the same tax burden whether it is Brazil or anywhere else. Non-resident organizations are subject to the IRPJ for the income obtained in Brazil or paid by Brazilian companies. And it is a federal tax. Taxes on return of the capital tax rate varies between 15 and 27, but it is modified based on the different rates that can be found in the federal, state, municipal. In addition, the following taxes will be found. Social contribution tax. Profit is taxed, and tax base is 12 of the gross income, different products, and it ends up being a tax of 9, except for financial institutions, which increases to 18. Contribution to the program of social integration. Taxes the total amount of monthly income, and tax rate is 0.65. Contribution to the financial social security, its difference is that rate is 3%, and its method of payment is also different. There are two tax systems. Real profits rates is 15 plus 10, at a higher value than 240,000 reals. The CSLL must be added with the tax of 9%, so the total tax would be 34. Presumed profit, to which an entity can avail itself as long as it meets certain requirements, invoice less than 48 million reals per year, and not making investments abroad. Financial entities cannot be accepted either. Companies are taxed on the amount that is presumed as profit without deduction of cost and expense per following the type of activities that it develops. Following is a summary. Let's look at it for a moment. Corporate tax, surcharge, social tax, and final rate. Yeah. Now we come to corporate tax in Canada. Canada Revenue Agency, yes, based on fiscal federalism. It involves an allocation of tax powers, distribution of responsibilities and competencies, instead of intergovernmental transfers. As in Brazil, the Canadian tax system has federal, provincial, and territorial and local taxes. However, the SCRA does not tax in the provinces of Alberta or Quebec, since there is no agreement between the federal administration and these provinces. In any case, provinces may apply other taxes, so each case should be analyzed. For intergovernment tax legal persons residing in their territory directly, we will see how they do it later. Canadian fiscal year again begins in 1/2/31. Established fiscal year 12 months when they start. Only condition is it does not exceed 53 weeks. And in cases using the modality, it cannot be changed unless there's an express approval by the competent authorities. Documentations that organizations must present is a balance sheet, the profits loss, statement of retained earnings, and a statement of cash flow. The balance sheet should be containing your assets, liabilities, your stock. The companies that will have to submit their financial quarterly. Canada has adopted international financial response reporting. These companies do not have to render public accounts. Can also get the account standards, a mandatory accounting standard. Private companies, SMEs, are the only companies obliged to IFRS under the income tax. Resident companies are considered to be incorporated in Canada. Where they have not been incorporated, they will be considered residents of Canada. Common law, as it may sometimes be lax, notation is understood to be in place where the board of the shareholders executes decisions. Canadian tax legislation allows profits of non-resident companies not to be taxed, except when these companies carry out their activity through a permanent establishment and profit comes from them. And in this way, permanent establishment of a company is defined as follows. Takes place where the activity of the non-resident tax takes place totally or partially, headquarters, office, branch. Representative of the central office, which can exercise authority and sign contracts on behalf of the non-resident company. Organizations resident in Canada are generally taxed on global profits. According to the ILC, non-resident companies are subject to the same tax burden, but they can take advantage of some exceptions. General tax rate, 15%. On the other hand, SMEs, whose capital is mainly Canada, may be taxed at a lower rate. And as previously mentioned, provincial tax must be added to this tax. There are usually two types, high and low. The high rate is usually applied to any income, while the low rate is attached to SMEs, or the following cases occur. On the income of the company considered small under federal standards, or the income of the company within standards established by each province. Now we have to go by each province. The low rate, the high rate, this is the extra tax from the province. Yes, yes. Which one has oh, I even got that. Okay, companies can deduct the necessary expenses to generate income. R&D generously encouraged. Considered a key element of Canadian venture. Yeah, federal tax, 15. I really did think it was 25. Anyway, venture tax. That's why you're coming up with the 25. Yeah. Ontario. Corporate tax in the U.S. is different. When countries discussed, tax is regulated by the standard of the Department of Treasury, responsible for enforcing the tax law. Title 26 includes all regulations of taxation. There are federal authorities, but there are other state and municipality. In these cases, each stage of development and implementation of their own jurisdictional law. Federal state does not exclude. Therefore, the corporate income tax is a federal tax to which other taxes will be added, depending on the state in which the activity takes place. The fiscal year does not have a coincide. It doesn't have to coincide with the calendar year. Each organization can adopt a fiscal year. It prefers as long as it ends on the last day of the month. If the company wants to exchange the selected fiscal year, it will need the authorization of IRS. Companies must submit an annual report, income, balance sheet, all the complementary notes, correspond to certified public accountant. Accounting rules that apply are based on the domestic standards, the Securities and Exchange Commission, the Financial Accounts Standards, Government Accounting Standards Board, and the Federal Accounting Standards Board. SME can take advantage of the U.S. generally applied accounting principles, standards, and other accounting bases. The U.S. tax system has a complex structure due to the levels of taxation before a company can begin to carry out its activities. It's advisable to study in detail in what state is going to do. So it's federal taxes added to the state and local tax, so the tax rate can vary significantly. In the same way, the establishment in one state or another will also vary assumptions and incentives from which society can benefit. As mentioned, it is necessary to analyze in detail each of the U.S. fiscal jurisdictions to benefit for the best conditions and comply with the fiscal obligations. Since the approval of the tax reform tax cut, the tax rate is generally 21, from which the corporation exemption must be subtracted and the state and local taxes added. As said, the tax rate imposed by the states can vary significantly from 3 all the way up to 12 in Iowa. There's a link in the appendix with your comparison to the different interest rates. In the United States, there are also different legal types of companies, so it will vary in the tax they must pay. In addition to the state in which the tax can be established, it's a good idea to analyze the most adequate type of company legal forms are. And here comes the terminology. Sole proprietorship established by a natural person. Tax obligation, same as for a natural person. This means that it is not subject to corporate tax. Partnerships, any person where legal that can be a member, and they also do not pay any, I would imagine that's supposed to say corporate tax. Limited liability. They can choose if they want to be treated as a partnership or a corporation. That is fiscal transparency policy. So C stands for corporation, corporate tax. S for corporations, pass through entities called S corporations. Companies whose taxation is not independent, but in each of its member taxes proportionally to the holdings, and in other words, have a fiscal transparency system. In that case, the corporate tax applies to its partners and members. S corporations have some requirements, one of which being retirement, being a resident of the United States. Members cannot be partnership or corporations. Shareholders must be residents of or U.S. citizens, and they cannot have more than 100 shareholders. And it should also be noted, there's no general mechanism to avoid double taxation in the United States beyond the bilateral agreement signed. And for this reason, many of the companies in the United States choose taxation as natural persons. However, the federal administration seeks to encourage foreign investments so that a foreign company would benefit in the same type of advantages as a local company. Natural persons and national resident companies are generally taxed on their worldwide income, while natural persons and non-resident foreign companies are taxed on their income in the United States only. State of Delaware, the second smallest state, is considered by many as a tax haven, and the reality is that there's no definition of what a tax haven is, and each country has a list of tax havens that can vary greatly. The case of Delaware has a number of features that many companies have taken advantage of, despite its small size and population. It's the home of the headquarters of more than 250,000 companies. It is considered a corporate offshore jurisdiction whose legislation allows the tax exemptions of LLC, as long as they're managed by non-resident foreigners who do not operate within the state. The subsidies are also exempt, so a company can establish its headquarters in Delaware, and the subsidies in other states in operation, similar to digital companies, which place their headquarters in countries where whose taxation is much lower. The laws of Delaware allow organizations to designate a single person with all charges or a sole shareholder, just the opposite of the rest of the state. It is also one of the 6 states that does not have a sales tax. In tax on natural persons is lower and progressive. It ranges from 2.5 to 5.9. On the contrary, the corporate tax for companies that do operate in the same state is higher than other states, standing at 8.7.